Learning from the mistakes of other people will help you reach your financial goals quicker. If you can avoid all 13 investing mistakes, you will accumulate wealth much faster than if you did fall for these pitfalls. I'm Sean. I teach personal finance and investing for beginners. Bop the like button and let's dive in. The first investing fumble people make is investing when they should be prioritizing another part of their financial life. There are three main things to consider before you start investing: emergency fund, high interest debt, and short-term financial goals. Investing is a long-term play, and before you focus on the future, you should be prepared for the present when hits the fan. You never know what's gonna happen in the future. Your car may break down, you have an emergency medical bill to take care of. Being able to cover your living expenses for a month at minimum, ideally 3 months, is huge. You don't want to be caught in a situation where you have no money and are forced to go into debt to pay off an emergency expense. Which brings us to consideration number 2, high interest debt. For most people, this is credit card debt, which will grow exponentially if you don't pay it off. If you have any high interest debt over 7% a year, then you want to focus on crushing that first. Lastly, if you need money for a short-term goal, such as an upcoming wedding or a house purchase, keeping that money designated for that goal in a high yield savings account is a much stable and safer way than investing it in a volatile stock market. Investing mistake number 12, timing the market. Beginner investors typically believe they can outsmart the market. While buying low and selling high is ideal, it's easier said than done. If you're constantly watching the markets and buying and selling stocks often, you are slowly entering the day trading territory. Investing should be passive and a long-term play. You set it and forget it. Over decades, it's statistically very unlikely to beat the stock market. You may make a play and it might do well, but it's not sustainable. Fidelity did a study where the best investors over a 10-year period were those who had forgotten about their investments or those who had died. It's better to ignore the swings of the market and to just constantly invest. As the phrase goes, time in the market beats timing the market. Investing mistake number 11, all eggs in one basket. For beginner investors with little money, it may seem like there's no choice but to invest in a few select companies, simply because you can only afford a few company shares. And to be honest, it's exciting to go all in on one company. If it works out, you're a hero. But investing all eggs in one basket puts you at extreme risk. If your chosen company doesn't perform or even goes bankrupt, you lose a significant amount of your money. It's better to reduce risk by diversifying across many different companies. I made a video on the one stock you ever need to buy, which covers low-cost, broadly diversified index funds. Card and description below. Investing mistake number 10, forgetting to pay taxes. Many beginners forget that they need to pay taxes on their earning. If you sell a stock and make profits, then be prepared to pay taxes on those profits. There are two types of taxes to keep in mind when you are investing: short-term capital gains and long-term capital gains. Short-term capital gains have the same tax rates as income tax. If you sell a stock you've held for less than a year, then you will be paying expensive short-term capital gains. Long-term capital gains are at a much lower tax rate and occur when you have sold a stock you've held for more than a year. I'm specifically talking about stocks, but this applies to real estate, commodities, and bonds as well. For example, if you get paid $50K a year, short-term capital gains will have you paying 22%, and long-term capital gains will have you paying 15%. A good rule of thumb is that if you've lost money, then sell the stock before the 1-year mark, and if you expect to profit from a stock sell it after the 1-year mark. Investing mistake number 9, investing in a tax brokerage first. I myself fell for this one and opened my very first investing account with TD Ameritrade. It wasn't anything special, just a taxable brokerage account where I could buy and sell stocks. Nowadays, it seems like investing platforms such as Robinhood are the first experience that people have with investing. And that's fantastic. I'm always happy when people start their investing journeys. However, there are huge tax benefits to be had with tax-advantaged accounts such as 401ks and Roth IRAs. For 401k, your contributions are all pre-tax, which may put you in a lower income tax bracket. For a Roth IRA, you contribute after-tax money as you would for a regular taxable brokerage account. But for a Roth IRA, all of your contributions and earnings can be pulled out tax-free at the age of 59. Remember when I said investing was a long-term play? The difference between investing in a Roth IRA and a taxable brokerage account could be hundreds of thousands of dollars in taxes. If you can avoid taxes, take advantage of it. Vanguard, Fidelity, and Charles Schwab are 3 investing platforms that are great and have a Roth IRA you can invest in. But another one is M1 Finance, which has a Roth IRA, but also has fractional shares. In addition, it has fractional shares, which is ideal for beginners without a lot of money because you just need 1 penny to invest in any company you would like. With fractional shares, it doesn't take a lot of capital to start investing. I'll leave a link in the description below. Investing mistake number 8, investing in things you don't understand. One summer after high school, I saved up $1,000 lifeguarding, and I invested all $1,000 into penny stocks. I didn't know what the companies were or what they did, but I could buy a lot of them because they were so cheap. I was stoked to see my stocks jump up even $0.50 because since the stocks were so cheap, a $0.50 increase was a pretty significant amount. But in the end, the companies I invested in didn't do so hot, and I lost nearly all of my hard-earned money. Pretty recently, there's been a huge craze in cryptocurrency. Tons of investors hopped in on this trend because they didn't want to miss out potentially making millions of dollars. Eventually, the bubble burst and the value of crypto heavily fell. Another thing I often see a lot is a lot of young investors buying a large percentage of bonds. A bond essentially being a loan to a company or government. Bonds are considered stable investments but don't offer a high return like investing in the stock market. If you're young, you probably have a long time horizon before you need to take that money out. By investing in bonds at such a young age, you are missing out on all the potential growth to be made in the stock market. In the end, you should not invest in anything you don't understand. And if you don't understand something, look it up, educate yourself, and then make the educated decision based around your financial goals. Investing mistake number 7, investing based on popular trends. I hear investing opinions all of the time. This company will create a vaccine for the Rona. Weed will be popping in no time. Tesla and Elon Musk will never fail. While all of those predictions may come true, it's really just speculation. And be sure to not be influenced by unreliable sources. You wouldn't ask an accountant how to code up a program. Do your own due diligence before you invest your hard-earned money, and make sure you draw your information from reliable sources. Investing mistake number 6, choosing funds with high fees. Perhaps you've stumbled across the term index funds and are intrigued by the low-cost way to broadly diversify your investments. I'm a huge proponent for low-cost index funds because they diversify across many different companies. I don't want to spend all of my time researching companies hoping to pick the breadwinners. I'd rather use my money to buy every single company, essentially the entire stock market, and then use my free time on things that I care about. For instance, if you buy VTI, 1 share of VTI contains all of the US companies publicly traded. However, you have to be careful of the mutual funds out there with ridiculously high fees. It's not atypical to see a mutual fund with a 1% fee, which means you're paying 1% every single year. This 1% goes to the fund managers and team of analysts who are constantly trying to find the breadwinners in the stock market. We know that 95% of financial professionals can't even beat the return of the stock market, so you are saving a lot of time and effort by just investing with the market. There are tons of ETFs and low-cost index funds with an expense ratio of just 0.03%. If you want to learn the differences, pros and cons of ETFs, low-cost index funds, and mutual funds, I'll link in the card and description below. Investing mistake number 5, setting unreal expectations. Many people go into investing thinking they're gonna get rich quick. But if you take the investing risk required to strike it big, you could just as easily and just as quickly lose all of your money. There are stories out there where people are leveraging huge amounts of debt hoping that they can make a ton of money. And it might work out for them, it might not. But I would be shattered to see all my hard-earned money disappear in an instant. Investing is all about getting rich slowly and consistently. You can win big by just diversifying your investments and growing with the stock market. Slow growth is lasting growth and is what you should be content with. Investing mistake number 4. Past performance is no guarantee of future results. Beginner investors will look at a stock's history to determine its future performance. They look at a stock and see that it has grown the past year, and so they invest a lot of money into it, expecting it to grow the following year. Wrong! This logic is flawed. The trajectory of the past doesn't indicate the same results in the future. A stock that went up the previous year can just as easily go down the following year. The stock market is incredibly volatile, and in the short term, we just really don't know what's going to happen. Don't go chasing the ball where it was, but go after where the ball will be. In other words, don't invest where the money has been, but where the money will be. Investing mistake number 3. Watching the markets too much. Scrupulously watching every market move is not only unhealthy, but could be detrimental to your investing decisions. Paying close attention to the markets can lead to potentially damaging investing behaviors, such as timing the market. Like in the Fidelity study, over a 10-year period, the best investors were those who had forgotten or those who had died. Take the human influence out of investing and stick to your investing strategy. Also, watching the markets is time consuming, and I truly believe that investing should be a passive way to accumulate wealth. Investing mistake number 2, not reinvesting dividends. Every quarter, some companies pay out dividends. With the extra earnings, a company may decide not to reinvest in a certain department, but rather pay it out to its shareholders as a reward to investors for putting their money in the company. However, many investors forget to set up dividend reinvesting, so whenever they get their dividends, it's just sitting in their account, not being invested. Make sure you set up DRIP or a dividend reinvestment plan so that your dividends you earn are automatically reinvested into the company or fund you chose. Automate as much as you can away when it comes to investing. Investing mistake number 1, investing too little. Right now is the youngest you will ever be. Now you're a few seconds older. No matter what age you are, the sooner you invest, the longer you let your money work for you. If attaining financial independence is something that you aspire to do, I urge you to invest more if you can. At a certain point, your investments will generate enough passive income that it'll cover your yearly expenses. And if you reach this point, work becomes optional. By not worrying about money, you have more freedom to explore your interests, potentially switch your careers to a more fulfilling one, or spend more time with your family. However, make sure you aren't so frugal that you stop enjoying life. Avoiding these investing mistakes will put you leagues ahead. If you learned something new, let me know. Leave a comment down below and let's keep this conversation going. I'll catch you all later. Peace.